CACFP Budget Requirements and Process. During this training, we will review why budgets and financial reporting is required in CACFP, review the annual budget process, common findings from quarterly report reviews, allowable versus unallowable costs, operating versus administrative costs, record-keeping requirements, and financial audits. You may be wondering why CACFP institutions are required by program regulations to maintain budgets and records of expenditures and revenues. All institutions are required by 7 CFR 226 to maintain a nonprofit food service operation. Here is the definition. All food service operations conducted by the institution principally for the benefit of enrolled participants, from which all of the program reimbursement funds are used solely for operations or improvement of such food service. In general terms, the institution must maintain records to support that all CACFP reimbursement is used solely for allowable program operation and administrative costs. In addition to the program regulations, 7 CFR 226, the institution must follow FNS 796-2 Revision 4 Guidance, Financial Management in CACFP, and 2 CFR Part 200, Subpart D. Allowable costs. Costs to operate and administer the program must be allowable. What are allowable costs? The term from FNS 796-2 Revision 4 is bona fide obligations of the institution incurred for the actual operation and administration of the program. All allowable costs require either prior or specific prior written approval by the state agency. Overall, costs must be necessary, reasonable, allowable, and appropriately documented. To receive prior or specific prior written approval of operation and administrative expenses before they are incurred, the institution must submit a budget for approval to the state agency. This includes budget amendments for expenses that were not included in the original budget. It is important to note an ordinary allowable expense is unallowable if the expense is not included in the approved budget prior to incurring the expense. Financial viability. An institution must be financially viable. Based on program regulations, an institution must demonstrate that it has adequate financial resources to operate and administer the CACFP on a daily basis, has adequate sources of funds to continue to pay expenses during temporary interruptions in program payments and/or pay debts when fiscal claims have been assessed. Examples of fiscal claims would be an overclaim verified by the state agency during a program review, or an unallowable expense claimed for program reimbursements. Each of the terms we just covered are why annual budgets and expenditure revenue reports are required and important documents in CACFP. Annual budget process for CACFP. The first step in the annual budget process begins in April. SDE will distribute the next fiscal year budget workbook to all program contacts and executive directors by the first week of April. The workbook is sent through the SDE broadcast email system, which limits who the workbook may be sent to in each institution. It's important to note if the program contact or executive director are not the individual in your institution to complete the workbook, to forward the workbook to the correct individual. The CACFP program year begins October 1st and runs through September 30th. The budget process begins early, so institutions may plan ahead, complete the workbook, and receive SDE approval before the program year begins. Independent centers and sponsoring organizations of centers' budget workbooks are due to the SDE by June 1st, and the sponsoring organization of daycare homes' budget workbooks are due by August 5th. It is important the budget workbooks are complete and sufficient detailed information is provided for each budget item before submitting for approval to the SDE. Sponsors may contact the state agency with any questions to ensure the workbooks are complete. Sponsors must ensure the budget expenses listed are allowable. The state agency will provide guidance to the sponsors during this time to assist the institutions with completing the budgets. The next step in the process is when SDE reviews the institution's budget workbook and determines if it is complete and ready for approval. If additional information is needed, SDE will contact the institution for revisions or additional information before approving the budget. Once the budget workbook is approved, the institution will receive an email notification. The approved budget workbook file name will have in it SA Approved. This is very important since it will distinguish the file from the original budget workbook sent to SDE. The approved budget also has the signed SPWA form if applicable. Once the institution receives the approved workbook, the next step is to enter the approved budget summary in the next fiscal year application packet in My Idaho CNP in the sponsor budget detail form. It is important to attach the approved budget workbook in the budget detail as well. Quarterly expenditure and revenue reports. The budget process does not end once the budgets are approved. Based on cost principles in 796-2 Revision 4, institutions are responsible for accounting for costs correctly and for maintaining records and sufficient supporting documentation to demonstrate that costs claimed have been incurred, are allowable to the program, and comply with financial management requirements. Costs that are not properly documented and recorded are unallowable. During the program year, institutions must maintain records of the actual expenses and revenue for operating the program. This data must be reported in the ACQR report in My Idaho CNP for each federal fiscal quarter. Here is the expenditure and revenue report in My Idaho CNP. At any time in the program year, if you find you've made a mistake in one of the quarter reports, you may access the report for that quarter and update the form. If you update the form, it is important to contact SDE so they may review and accept the changes in My Idaho CNP. The federal fiscal year quarters and due dates to submit the report are: Quarter 1 is due January 15th and covers October, November, and December. Quarter 2 is due April 15th and covers January, February, and March. Quarter 3 is due July 15th and covers April, May, and June. And Quarter 4, the last quarter in the year, is due October 15th and covers July, August, and September. Budget amendments. Since budgeted expenses and revenue are estimates, it is sometimes necessary to submit budget amendments. Budget amendments may be submitted to the state agency as needed by the institution. The final budget amendment must be submitted to the state agency by September 1st in order for the state agency to review and approve the revisions prior to the institution incurring the expense or revenue. Institutions shall monitor their budget on a regular basis. When entering actual expenses and revenue in the quarterly reports, it is a good time to review your institution's budget status. In the far right column in the quarterly report is the percentage of the budget that has been expended. If your institution is in the second quarter, halfway through the program operation, and the expenditure on the food and milk is already at 95%, you will need to complete a budget amendment. Institutions may not go over more than 10% per any line item expense. Any amount over 10% on any line item will be unallowable and must be paid with other program funds. It is important to submit an amended budget and receive approval before incurring the expense. To submit a budget amendment to SDE, use the institution's SA-approved budget workbook and make any necessary changes in the workbook. If you cannot find the SA-approved workbook in your files, you may access the most current approved budget in My Idaho CNP Sponsor Budget Detail in the institution's application packet. Once the workbook is updated, submit the amended budget to SDE for approval. Once SDE approves the amended budget, SDE will update My Idaho CNP Sponsor Budget Detail, attach the current approved amended budget workbook in the budget detail form, and send an email notification that the budget amendment is approved. At this point, when the institution accesses the quarterly reports, the percentage expended is updated. Common findings on quarterly reports. Some common findings the state agency is determining on the quarterly reports include reimbursement reported in the incorrect quarter. It is important reimbursement is reported based on the months earned. For example, first quarter reimbursement would be the amount of reimbursement claimed in October, November, and December. Reimbursement is not based on the month received, since each sponsor submits their claim at different times. For example, a sponsor may submit a December claim in January. In this case, January would be the month that the claim was received, not the month in which the reimbursement was earned. The most consistent reporting method is based on when the reimbursement is earned. Expenses reported under incorrect category. An example is if non-food supplies like napkins or paper plates are reported under the food category. It is important the sponsor has a method to separate the expenses on receipts, invoices, and in their accounting system, so the correct expense is reported under the correct category. Expenses reported in the incorrect quarter. Expenses must be reported on an accrual basis when cost is incurred. This is when the goods or services are received. Examples: when the food is purchased at the store, when products are delivered from a vendor, or when a service such as equipment repair is completed. It is not based on when the product will be used, or in some cases paid by the institution. This is the most consistent method for the state agency to verify and monitor all institution quarterly reports. Labor and benefits. Operating and administrative expenses reported based on estimates or percentages. Institutions must maintain time and attendance reports for all labor costs. Labor costs include salaries, wages, and benefits charged to CACFP for hourly or salaried employees for part-time, full-time, or piecework. Reports must include the total time actually worked by the employee, not just the time spent on CACFP duties. The CACFP time must be recorded by time spent between administrative and operating duties. The portion of labor costs charged to the nonprofit food service account must be allocated based on hours worked in CACFP and non-program duties found in 796-2 Revision 4, pages 44 to 50. The institution shall maintain a written compensation plan which includes these procedures. Unallowable expenses included in reported totals. For example, including cream cheese, granola bars, and candy costs under food expenses. Another example would be an expense that was not approved in the budget. An allowable expense will be unallowable if prior or specific written approval is not received from the state agency prior to purchasing the product or service. Approval only occurs through the approval process of the budget workbooks. Expenses reported as estimate, not actual cost. It is important all expenses are reported based on actual costs for operating the CACFP, whether CACFP reimbursement or other funds are used to pay the expenses. Quarterly reports are used by the state agency to verify the institution is operating a non-profit food service and is financially viable to maintain the program. Allowable versus unallowable costs. Let's now talk a little more about allowable and unallowable costs. Costs must be necessary, reasonable, and required to operate in the CACFP. The cost should reflect what a sensible or practical person would pay. For example, if purchasing a car for monitors, an organization would not purchase a Lexus when an economical vehicle would be more reasonable. Legal under state and local law. In order to be allowable, the cost must be authorized or at least not prohibited under federal, state, or local laws and regulations. Some state or local laws are more restrictive than federal laws and regulations, and therefore may prohibit certain costs. Here is an example. Some states or local governments organizations have lower small purchase thresholds than the current federal small purchase threshold. An institution wishing to vend meals or procure other services must make sure it follows the state-local small purchase threshold if the state-local small purchase threshold is lower than the federal threshold. Conform with federal regulations. The cost must conform to limits or exclusions as set forth in FNS Instruction 7962 Revision 4 and federal laws or other governing regulations. If a cost is prohibited by the IRS, it cannot be allowed in CACFP. Here's an example. Personal expenses are not deductible as business expenses under both the IRS rules and CACFP regulations. On the other hand, car expenses associated with conducting CACFP reviews are allowable business expenses under all federal laws, and reimbursement is based on the actual mileage driven to conduct the reviews. Consistent treatment. The cost must be treated consistently through the application of US GAAP principles. This means the same cost cannot be charged differently depending on the program to which it is assigned. FNS Instruction 796-2 Revision 4, Section 7A2. For example, if an organization pays 55 cents per mile for business travel for the staff that conducts non-CACFP travel, it cannot claim 60 cents per mile for CACFP business travel. All expenses and revenue must be documented and the institution must maintain the documentation. If an expense in the budget is allocable, it must be allocated accurately, and if prior or specific prior written approval is necessary, it is approved by SDE before the institution assumes the cost. Costs must be approved by SDE in the institution's budget before the institution may begin spending CACFP funds on the costs. Allowable versus unallowable costs. Unallowable costs are costs that are not a reasonable expense specifically for the CACFP, costs that are not necessary for the operation administration of the CACFP. Examples of unallowable non-food supplies are diapers, baby wipes, and toothbrushes. Costs that are not approved in the CACFP budget or a budget amendment. Costs that are not properly allocated between CACFP and other non-CACFP programs. Less than arm's length transactions that are not properly disclosed and approved. Alcoholic beverages. Paying bad debts, entertainment, including amusement, diversion, and social activities, and any costs directly associated with such costs, such as tickets to shows or sports events, meals, lodging, rentals, transportation, and gratuities. Lobbying, contracting with the sponsoring organization's employees, officers, or board members, and recruitment incentive payments to employees of a sponsoring organization of daycare homes, either with program or non-program money. 7 CFR 226.16 Note: recruitment incentives are an unallowable activity, even with non-program funds. However, employees can be paid or evaluated on the basis of recruitment activities accomplished. More information on allowable and unallowable costs is located in FNS 796-2 Revision 4 Financial Management Manual. Operating versus administrative costs. What is the difference between operating and administrative costs? Operating costs are any expenses to plan, prepare, and serve the meals and snacks in the program. Here are some examples of operating costs. Food. Food service labor and benefits. Non-food supplies. Food service equipment. Activities to plan, prepare, and serve the meals or snacks. This includes preparing and completing menu records and purchasing the food and supplies. This also includes the time to plan and create menus for purchasing the food and non-food supplies. Administrative costs are any expenses to plan, organize, and manage the program. This includes completing the CACFP application, recruiting and hiring, preparing and monitoring the budget, monitoring facilities, and providing training to organizations and facilities. Examples of administrative costs: administrative labor and benefits, activities to plan, organize, and manage the program, including the time to consolidate and submit the claim for reimbursement, office and training supplies, office equipment. Training costs included travel for trainings or conferences, monitoring travel expenses. Record-keeping requirements. All records to support the budget expenses and revenue must be maintained for 3 years plus the current program year in CACFP. This includes, but is not limited to, food and supply receipts, invoices, purchase orders, itemized cash receipts, delivery tickets, cost records for transportation such as mileage records, expenses related to vended meals, lease or rental invoices, training and travel receipts, timesheets, time and effort reports, and payroll records, electronic or written financial ledgers. Financial audits. An audit is a procedure where a professional auditing firm is hired to assess financial operations. An institution that annually expends $750,000 or more in federal funds is required to submit their financial audit to SDE no more than 9 months after their audit cycle ends or as requested. For example, if the institution fiscal year ends June 30th, the financial audit must be submitted to SDE by March 30th of the next calendar year. Unless otherwise exempt, audits at the state and institution levels must be conducted in accordance with 2 CFR Part 200, Subpart F, Appendices 10 and 11, Data Collection Form and Compliance Supplement, respectively, and USDA Implementing Regulations 2 CFR Parts 400, 415, and 416. SDE will ensure that the required audits are performed and review the audits for compliance. The SDE Finance Department reviews all school district audits annually. For all other nonprofit or for-profit institutions, SDE contracts with an auditing firm to review the financial audits. The objective of an audit is to evaluate the integrity of an institution's financial data. The contracting auditing firm will assess CACFP's financial operations. Specifically, an audit will determine if an institution's financial statement fairly represents its financial position, financial operations are in accordance with generally accepted accounting principles, and internal control systems provide reasonable assurance that it is managing federal funds in compliance with laws and regulations. Audit review findings. If the institution has any audit findings or a management letter reflecting any material weakness, the institution's auditor must submit a copy of the audit and management letter to SDE Child Nutrition Programs within 9 months of the close of the institution's fiscal year. If any findings are determined by an SDE contracting auditing firm or SDE Financial Department, SDE will issue an audit review finding notice and require a corrective action plan. When an acceptable corrective action plan is received by the SDE, a review closure notice will be issued. If no findings are determined, an audit review closure notice will be issued once the audit review is completed. SDE has established an audit policy for for-profit institutions to certify 25% eligibility for each monthly claim submitted in My Idaho CNP, and to verify enrollment eligibility during for-profit program reviews conducted by SDE. In addition, SDE may require for-profit institutions to submit an audit to SDE for review. Annually, all institutions, nonprofit or for-profit, must submit current financial statements to SDE as part of the annual application updates for the SDE to review for financial viability, capability, and accountability, otherwise known as VCA. More information on the annual application updates is located in the Application and Annual Update section of the CACFP manual. In this training, we have reviewed the following: why budgets and financial reporting is required in CACFP, the annual budget process, common findings from quarterly report reviews, what are allowable versus unallowable costs, operating versus administrative costs in CACFP, record-keeping requirements, and financial audits.